All right, Blake, another episode of Thinking Property. To start off, I want to talk about the main news story of the day in the finance world, which is that the Fed decided not to raise interest rates. So, right now, they're currently where they have been. And a lot of people have some different opinions and they want to opine on, well, does this help the economy? Does this hurt the economy? And all of these things. But I want to ask you that straightforward question. What happens now? Where
Yeah.
does this go? And the one thing I do want to mention before you answer is that the second quarter of the economic growth was only at 1.4% GDP compared to
Yeah.
what it was prior. So do you think that the Fed kind of realized, like, hey, we need to pull back on this a little bit, or hey,
Yeah, well,
we're going to kill the economy?
that's exactly what happened. They looked at the numbers and they realized, wait, hold on a second. The GDP isn't growing like expected or like it's typically expected to. And at the same point in time, job openings, although there's still a lot of job openings remaining, it has went down. It has shrunk for the first time in about 3 years. And a few things that they look at the Fed when they determine these rates is what's the unemployment number and what's the inflation number? And inflation is up, unemployment is still relatively low, but job openings are down. So they're realizing that the effect of the interest rates on the economy is really starting to take hold. Um, so the pause doesn't surprise me. What can we expect short term? Well, short term, I think obviously the pausing of rates will give a little bit of time to the real estate market to be able to stabilize, since that's the market that is most highly affected by interest rates on the loans. Because, if you're looking at a 6 or 7% interest rate on a $400,000 home, that might push some buyers away, right? So I
Hmm.
expect to see the real estate market stabilize a little bit. I also expect to see the car market stabilize a little bit, although the rates are historically high. So let me look, and I want to show you some stats that I have here about how much interest rates really do affect the economy. So looking specifically at cars, like I just mentioned, interest rates, and I'm going to go back and look at the early 1980s and I guess technically late 1970s. So let me read this for you. Interest rates rose from 10% in 1979 to 17% in 1981. Both of those numbers are historically high. But with that being said, car sales fell by 1.5 million over that period of time. Well, then in the 90s, right, interest rates fell from 7% to 4%. And within that time, 2 million more cars were sold. In the early 2000s, interest rates went back up again from 4% to 6%, and car sales fell by 3 million units. And then, as we know, in the 2010s, rates went from 6% down to 4% again, and car sales rose by 2.5 million. So basically, what we see that these numbers are correlated because they look at the interest rate and realize, wait, hold on, why would I go get a new car if I'm paying 10% or 5% interest when I have a car that continues to work and I got my payment on it at 3%, right? So it
Hmm.
has slowed things down. We've continued to see these rates slow things down. We see a lower inventory in the housing market. We see a lower amount of buyers in the housing market. That's why it's kind of stabilized. But ultimately, I think that this pause is probably good because at least it's not continuing to go up. Because when it goes up, it costs everybody more money to borrow money, which makes everything more expensive.
I agree with you, and especially looking at that car example, the way that I've always viewed it is when money is easily available and cheap, you can tend to go out and, hey, you know what? I have the luxury or the opportunity to go out and buy something new for myself. And a lot of people have that consumeristic personality where it's a new car every 2 to 3 years, or
Yeah.
it's this for the wife because she can't drive one with 30,000 miles and all this stuff. And so I really see it actually kind of like, believe it or not, I'm going to kind of use this comparison, but like with COVID, like, you know how during COVID, really there were no elective surgery procedures. It was just
Yeah.
like the hardcore, you need it. It's the same thing, metaphorically speaking, with this financial term right now is like, if you need a new car, then you're still going to have to suck it up and go get a new car more than likely. And so the sales won't dip that drastically because there's going to be people who, they have to
Yeah.
get into new car from a clunker. But then there's that group of people, just like you said, where they just, it's not at a low interest rate. It's not easy or cheap to get money. So they're saying, do you think my wife can, drive a Honda Pilot with 30,000 miles on it used? Yeah, it might be able to continue going that way. So I think
Yeah.
that you're absolutely right there. And it's also important to recognize that these interest rates, although historically high over the last 10 years, over the lifetime of really interest rates as a whole, we're still at relatively low numbers. So it wouldn't surprise me if the Fed decides to
Yeah.
boost things up. I mean, you talked about the 80s as an example. You were seeing interest rates well above 10, 15%. I know that our dad, as an example, said, oh, yeah, houses at 18% was normal. So that is just one thing to see. I think that they have some room to continue to raise, but more than likely, I'd say, they're going to, as the economy
I,
slows, they'll
I,
slow
I
theirs as
think
well.
I agree with you, and I think this third quarter will tell a lot because I don't expect a high GDP number. I hear the professionals forecasting a pretty large GDP number, 3% to 5%, believe it or not, some of them.
Really?
But I think we're going to see a lower number, probably even lower than that 1.4% number. And that's why they're pausing these rates because they want to
Hmm.
make sure that they're not going too far. They're aiming for the soft landing, which probably isn't possible at this point, but they're going to
Yeah.
aim for that.